I'm so nervous.
There we go. It'll be great. Okay, I'm gonna
That'll be
let
the first thing people hear. So wonderful. Well, we have people joining. Oh,
that
Marika.
we
Well, I
do.
know some of these people.
Yep, gonna be some familiar faces.
Oh my gosh, very familiar.
I'm really only here to fangirl over Richard.
Well, we're so glad.
That's very sweet. You know what? That is the nicest thing anyone has said to me today.
I think that might actually be the nicest thing I've ever said to you.
By far. By far. Um, well, as people gather, I appreciate you all joining to behold what I have prepared.
Yes, we're excited to have you. And I will go ahead and kick it off and hand it over to you, Richard. So thank you all for joining. I'm Natalie Layton, President and CEO of the Yountville Chamber of Commerce. We're excited to be joined today by Richard Hall with WeinStrategies to go over financial statements, simplified, and how you can implement them in your business. Before I hand it over to him, a couple of notes. This session is being recorded and will be made available on the Chamber's YouTube page. And if you have any questions throughout the presentation, please feel free to throw them either in the chat or in the Q&A that should be on the bottom of your screen. So with that, I'm going to hand it over to Richard and let him take it away.
Okay, well, thank you, Natalie and Chamber. It's been a long time since I've seen you all, or at least seen you in the capacity when I was the treasurer at the Chamber of Commerce. Maybe just a little bit about myself. So, as mentioned, I have a company. Technically, it's a German name, WeinStrategies. Wein or Wein is the German word for wine. My background and experience has really been in corporate finance and financial planning since 1993 when I graduated, technically in 92 from UC Santa Cruz, and then spent a year in Germany, but have moved on into corporate business planning for large organizations, publicly held, as well as small private family enterprises. Most notably, I was the chief financial officer at Cliff Lady Vineyards for almost 15 years, but have been working in and around the wine business, starting with Leslie Rudd Investment Company back in 2002. I presently have my own business where I consult as a finance and operational strategic executive, working with CEOs, other finance related people and organizations to help them identify and improve their business model, economic model with regards to their financial operations, but also looking at various operational areas of their business. So today, what we're going to do to keep it really, really simple, because a lot of this stuff is seemingly complex. I'm going to try to simplify the financial statements. And in doing so, hopefully give you all enough information to be really, really dangerous, but also the tools to kind of understand and interpret what and how people like myself review, evaluate, and make decisions upon the information that come out of a company's finances. So with that, I think I'll ask my peers, is my financial statement simplified screen being shared at this point? Excellent. Okay. So with that, I will do my best not to make any mistakes on my presentation. I think I've got it dialed in, but bear with me because I'm a finance person. I'm not a marketing person. So I'll do my very best to make this reasonable, and hopefully I didn't make too many transition errors. But first of all, I'll just make sure I get focused here. That's me. This is about all the excitement you're going to get in this whole presentation, is the few transitions I can have. So why financial statements? Um, they're fun. Okay. People who are in finance, if they don't come at this stuff from a fun standpoint, then they're missing the whole picture. Business isn't supposed to be rote and routine and things that we don't engage and get excited about. Financial statements are a really important part. And I think that in saying that, we have to understand what it is. Accounting for what ultimately produces the financial statements. Accounting is the scorecard of business. It's hard for people that don't work in the world of finance and accounting to understand that, but really all it is it's collecting information and organizing it in a way, like a language, that we use to quote unquote keep score, typically with dollars or other currency, but it is the scorecard of business. It should support the decision-making process in any business because it is a reflection of what the business is doing. When we pay payroll, we put money into the salaries and wages, and that manifests itself. And we'll see some of that as we look through the rest of the presentation and what the financial statements look like. And if you've seen financial statements in the past, all I'm really hoping to do is to illuminate them for you and give you some sort of key areas that were helpful when you're looking at them, but also maybe to give you some additional insight that you didn't have as to how they're all related. They provide information, obviously, for banks, other businesses, other relationships that you might have. We talk a little bit about private and public business. Public businesses, when I use that terminology, I'm thinking about the companies that you hear about on the news, Microsoft, those companies that are listed on stock exchanges. Financial statements are vitally important for people making investment decisions, you and I, in our 401ks. When I talk about private businesses, think about wineries in the Napa Valley. Not all of them are private. There are some very large ones. Robert Mondavi, owned by Constellation. That's a public business. But most of the other wineries and businesses in the Napa Valley, the hospital is technically privately owned. I'm thinking of St. Helena. It's a privately owned enterprise. They generate their own financials to see their performance and continue their success or understand where their challenges are. Nonprofit. I know that the chamber is a 501c6, which is technically a type of a nonprofit organization, but we compile financial statements for those organizations too, so that we can communicate with the people that are making those investments, supporting or giving contributions or monies to those organizations, like the members on this call, how they operate their business and where they make or don't have success with what they're operating on and how they have to make changes. Government financial statements. Big news yesterday in the town of Yountville. The town also has a budget and financial statements that it produces. And if you haven't ever really delved into it, they're all public knowledge. They're all public information. They're really, really interesting. I mean, I think so. But they're things that you could familiarize yourself if you wanted to learn more about how governments look at finance. And it's a separate type of accounting and finance statement that gets produced, but it's also very meaningful and important. And we'll talk a little bit about that, but I really am focusing more on private business or those businesses that are non-governmental or non-profit. Hopefully we have a profit in our business. We don't always. And then lastly, personal financial statements. Everyone on this call, assumedly, if you have income, you have a job, or you get paid for washing the car, you have costs that are associated with doing that, your everyday life, whether it's to buy the soap to wash the car or to go buy food to sustain yourself so that you can wash the car. You could build your own personal financial statements. And I think that that's where in the beginning, if you start by understanding your own personal financial statements, your income minus your expenses to show you what your leftover profit or potential savings are, that's maybe a way that a lot of people, at least the way I started in getting into this, was understanding it myself, how I managed it internally. All right, so let's have some fun. What are financial statements? There's really three principal financial statements. In fact, there are three. People call them different things. I like to start with the balance sheet. So what is the balance sheet? The balance sheet we'll talk about in a little further detail, but it's a snapshot. At a point in time, it's the assets, which are the things you own. It's the liabilities, the things you owe, and it's the equity. The things that if you sold everything that you owned and got paid everything you owed, that'd be what was left, if anything. And sometimes there's not. Sometimes at the end of the day, you owe more money than the things that you own. And those are things that in business we are mindful of. The income statement. So the income statement is an operating statement. It is a duration of time or a period. So there's a difference, right? The snapshot is the balance sheet, point in time, and the income statement is the duration of time, a period. We call those the profit and loss, or sometimes people call them a statement of operations, but it's the income statement. And the reason we call it income is because it's the nice way of saying, it's the way we make money at the end of the day. Oftentimes the income statement is a loss, but we don't call it a loss statement. That would be rude. Cash flow. So cash flow is really kind of as a small business or a private business, and largely, and I'll talk with a focus towards the wine industry, cash is in the cash flow statement is really imperative to the success and the health of a business. Specifically, what we have is the money that we spend or that we generate, that we then spend based on what it takes us to operate through our income statement and our balance sheet. It all ultimately manifests itself into what resides in the bank account. The cash flow links all of those through net income and cash. And we'll talk a little bit about that. You'll hear terms when you're working in business of the types of accounting and how we record information on the system or in our accounting systems, which we'll talk a little bit about as well. And we talk about cash versus accrual. The simple answer or explanation to cash versus accrual is on a daily basis, if I write a check and I put it in my financial statements as an individual, it's cash. If I were to receive a bill, but it's not due until next month, in principle, the bill was for something I incurred. I could accrue that, and that would be an accrual type of accounting that we might follow. And what accrual does for businesses, because they report on an annual basis, is it allows them, number one, to smooth the actual expenses they incur. So if you buy something and you have to write the check and it's a big number that you're going to spread over multiple periods, you might look at accrual type accounting. We think about prepaids and things like that we might incur. It's just another name for a type of accounting that we use that helps a business normalize what it's presenting, so it doesn't have these whipsaw gyrations that aren't explainable or are explainable only from a pure cash standpoint. It's also something that provides the differentiation between net income and cash flow. Industry specific. Why did I write that? Because every business, every industry has subtle nuances in the way it does its accounting and its financial reporting. The wine industry is really, really subtly nuanced and actually quite complex in many ways because we have inventory. And the way we make inventory is we grow grapes for 12 months and then we don't sell them until they're finished goods for another 2 years. And so there's a real specific way we have to do the accounting, or we should do the accounting for that. And in fact, there's GAAP rules that we'll talk about in a second. But that's what we end up having to manage and how we manage our books so that we have these normal explanations for what our business looks like. I mentioned a little bit earlier about private versus public reporting. Private reporting is the internal financials that wineries and businesses in Napa County might have if they're not large and reporting to Wall Street or one of the large investment areas people put money, the NASDAQ or S&P, wherever they may be raising capital in those areas, in those exchanges. But we won't really delve into that much. I touch on it, but for this purpose, it's mostly going to be private business and those kinds of accounting. There's also differences between the US and the rest of the world for how we do accounting. And those are important to know because oftentimes there are foreign investors, or you may be looking at foreign investments and how they do their accounting. You have to understand it because its impact on your ability to interpret their results and how you might use those for your decision making is different. In the US or domestically, we call what we do traditionally is GAAP accounting. And GAAP stands for, I should have written this out, but I won't because it'll bore people, generally accepted accounting principles. And that's exactly what it is. They're generally accepted, meaning that there's another large organization that manages and dictates what those are, but they're generally accepted. They're known, specific. And the reason we do that is so that we normalize information. So we don't have this everybody doing different stuff. And so it's codified. Lastly, double entry. You'll hear a little bit about this, debits versus credits. I wish there was a really simple answer to what debits versus credits are. Probably the best way to explain it is anytime we debit something in the accounting. So if I receive money, I debit cash, I have to credit something. Well, we'll talk a little bit more about what I might credit, but typically for a real simple basis, if I sell a bottle of wine, someone gives me $10, I'm going to debit cash and I'm going to credit sales. Don't get too confused. I'm already confused. But we have double entry, meaning that we do that, it has to balance. We can't put $10 in cash and then not put $10 somewhere else because we just created a magic $10. We have double entry accounting. We got to have a way to document what and why we did what we did. And that's how we do it, through a balancing system. Okay, who prepares these things? Internal staff. As you guys probably know, there's lots of people that you've interacted with, lots of different roles in the world, but most companies have their own internal staff to do their accounting for them. Sometimes it's the family, or you're doing it yourself. Small businesses, oftentimes the accountant is the chief bottle washer, is the salesperson, and that's perfectly reasonable. But those are the kinds of people that are touching and putting information, and it's important that they do that and that they document it so they can explain to others, who we'll talk about in a second, to people who want to see it, to be or not to be. A CPA. CPA is a certified public accountant. I'll make an argument. They don't do a lot of financial statement work. They do a lot of tax work. That's what they do. They're ultimately there to support and be instructive on how your financial statements are going to impact your tax situation. An MBA, they may be involved with putting your tax in, but people don't have to have those certifications to do financials, right? Anybody can do the financials, as I mentioned, internal staff, family, whatever. All those folks can do accounting and set up your financial statements in a financial system. External third parties, you can hire people to come do it. There's lots of firms, bookkeeping firms, larger firms that will do your accounting for you and produce your financial statements. Let's talk a little bit about the roles in accounting, and we'll rip through this because most of you probably know this already, but just want to make sure we didn't miss anything or too much. Most accounting and the work that is done in accounting is done by clerks, accounts payable, accounts receivable, billing, people that are doing those kinds of activities, transaction work. They don't have to have a degree in accounting to do accounting. They just have to know and understand how the systems are set up and what the basic premise behind it is. Then we have accounting staff. So people that are trained, maybe gone to school, have gone to college and gotten a couple years of experience, or have worked as accountants in the past. You also have supervisor level, manager levels. When we think about larger organizations, you start stratifying who does the work so that you're effectively using people in the time based on the volume of work that you need them to do. As you might imagine, people receive a lot of invoices for things that they spend money on. You don't want to put your CFO or your controller on those activities because their time may be better spent in reviewing and analyzing and understanding, building budgets. So we have lots of different people that get involved. Kind of the top person in the accounting organization is the controller, and they do exactly that. They control the books and records. And again, the books and records are the scorecard. So you want that person who's got experience, who understands what they have in front of them, where they want things codified or how to structure and organize their accounting records so that they can produce accurate financial statements. They don't have to be a CPA. They don't have to be an MBA. Lots of controllers have experience over years, and they've just developed that internal knowledge. It's like a language. We were joking about speaking French earlier or German. Accounting is a language. And then lastly, you have people like me who really shouldn't be touching any accounting because I'm not that good at it. I'm good at understanding it, but the reality is, and I'm good at communicating it, but the reality is you're better served having other people that know where things go on a routine basis doing the accounting work. Someone like me comes in and just messes it up. All right. Who uses financial statements? Well, all of us. We all really do, whether you know it or not, directly or indirectly. But principally, financial statements are produced for management. Why? Because this is decision support information. Managers need to make decisions. And if we don't have good information, we don't make good decisions. Oftentimes we get good information, we make bad decisions anyway. But if we get bad information, we're certainly going to make a bad decision because we don't have the right facts. Financial statements help you organize and ensure you have the right facts. It is truly, at the end of the day, decision support information. The other people who might use the financial statements would be investors or owners. People are going to have money that they're going to put into businesses. They're going to capitalize it, whether they do it through debt or equity, which we'll talk about in a minute. But they want to have financial statements that tell them, how is their money being put to work? How is their money being utilized effectively or not? And although you won't learn that in this particular presentation, I'll do my best to tell you how you might evaluate it. Everyone also has a different reason for why they want to look at the financials and what they want the outcomes to be. And I can't fully say that I know every time that someone wants to have the earnings that we have. They may have different reasons for why they want them to be lower or higher for that matter. Certainly important for users of the financial statements are banks and creditors. And as we talk about the liabilities in a business, one of the most important things that a bank wants to understand is if it's going to loan money, which becomes a liability, are they going to get it back? And we all use debt. We all use banks and creditors to buy cars or our homes. These are your own personal financial statements. You could look at it that way. And that's how the banks actually look at it. That's how your creditors actually look at it. So these are all really important statements and information that people use for lots of different reasons. All right, the balance sheet. So as I mentioned, we're going to talk about the big three primarily. That's the crux of this meeting, this presentation. webinar, whatever we're calling them these days. And what I wanted to make sure is just to focus on kind of what those are, because we could talk all day, as you might imagine, I can talk all day and night about this stuff, but we need to focus on what's important. And so the financial statements, there's really the big three. And as I mentioned, the balance sheet is a snapshot. So a snapshot in time could be any point in time, but it's that moment, December 31st, April 30th, tomorrow. Those all are points in time. And what that means is that what it's a representation of is what that is at that point in time. The balance sheet is comprised of three basic areas: assets, kind of the things we own. But assets are, real simple. Cash is an asset. Accounts receivable, so people who owe you money, is an asset. Inventory, when you make it, ultimately is an asset. Fixed assets, and I didn't list them, but you can imagine what they are: buildings, land, equipment, vehicles, you name it. Anything that you could acquire to use for your business falls into that category. Things of that nature. And lastly, we have this funny concept called intangible. So an intangible asset is really important in the wine business. An intangible asset is a brand. Can I touch it? Not really. Is it got value? Absolutely. Can you define the value? That depends. We also talk about assets in the form and term of current versus long term. And what I mean by that is when we think about cash, cash is a very liquid asset. And we'll talk about liquidity. But it's a very liquid asset. I give someone $1, it's worth $1. If I give someone a receipt that's worth $10 from Joe, who bought something for me, is Joe going to pay? What's the value of that receipt or receivable that I have from Joe? Joe's a good guy, he's going to pay me, but it may take time. Typically, a current asset is something that we'll receive within 90 days, or that we'll monetize or convert within 90 days. Now, there's some exceptions to that. Inventory is considered a current asset. It's a unique current asset because we don't typically sell our inventory in 90 days unless we're selling widgets in like a spreadsheet. And then I sell them all in 90 days. I sell them all on day one. Inventory, especially in the wine business, can last years. And many of you on this call will know that. Sometimes we keep our library inventory, but we still reconcile that or recognize it in the current portion of our balance sheet. We'll keep going into the liabilities. So the liabilities are what a company owes. It's your AP. And what accounts payable means is I buy something, but instead of paying for it with cash, because we're doing accrual accounting, they send me a bill and I'm not going to pay it until it's due. We do this with our utility bill. We do this with, pick one bill that you get, my credit card bill. They send me that bill. I don't pay it until it's due. And not because I don't mean to pay it. The cash is more important to me over that time period. Hopefully I'm doing something with my cash, same as a business, that I'm using it more effectively, and I'll pay it when I owe it, when it's actually owed to someone else. Credit cards are also on a company's liability section of a balance sheet. And a credit card, as you all are familiar with, I'm assuming you're familiar with, that's another way to extend, again, credit to the company. Well, the credit is a liability to us because we owe the money at some point in time. We have things like notes payable. Notes payable in this terminology would be like debt. Whether the bank gave us a note, right? They loaned us $5 million to go make inventory or buy a piece of land, right? The asset was the land. Well, the other side, remember, debit the land. I've got the dual entry or the double entry accounting. Debit the land, credit the liability. They gave me $5 million. I bought a piece of dirt. I put that $5 million note that I owe you the bank as a liability. Debit, credit. Lastly, we have other debt associated with that. And those are like longer term things. You can have lots of different types of debt, whether it's notes from the bank or notes from people that you know. People borrow money from each other all the time to grow their businesses. They become owners in a sense, or debt holders in a sense, from the business. And I think the difference that I'll share with you on debt versus people giving you money and calling it equity is that unless there's a conversion premium or conversion feature, debt is something someone's loaning you and they have an expected date by which they want their money back, and typically a rate of interest by which they're loaning you the money because their money's not free. We talk about liabilities in the form of both current and long-term as well. Again, current, 90 days or less. My accounts payable, most of my vendors, if I buy something, they're not going to let me drag it out for 180 days, half a year. Not normally. If they do, then they're giving me additional credit. We typically would classify that if we don't have the ability to pay as current. But there's a reason why we try to structure it as such. And again, it comes back to how we evaluate people's financial statements. Things that are current, both liabilities and assets, we expect to see within 90 days. I think that maybe that feature, GAAP doesn't have a specific timeline on that. That feature can also extend beyond that because again, think about inventory, right? We hang that up for a year or more, sometimes 10 years, and we don't monetize it. But that's the concept and how we think about it is 90 days or less is typically current. Anything longer than that could be classified or should be classified probably as long-term. So the last piece here is equity. And equity is ownership. Okay. Equity is what you've generated in the long-term health of the business in either the form of retained earnings and net profit that you put into your financial statements because you generated cash and you have to offset that cash. You have it from income. It's gone into your balance sheet. Or you have it in ways that people make investments. So the other equity components that we think about are stock. Stock can be broken into different pieces. So what is stock? Stock is an ownership interest in the company. And typically that's given out in the form of a percentage of the ownership that would be distributed if the company were to sell or to no longer be in business. And a company can dissolve itself and no longer be in business and no one else would buy it necessarily. So I think what I'm saying here to make it simple is that there's a lot of different types of equity. And those that I've broken out here are the preferred stock, which would have some preference, meaning it's got something that's greater, it's a little more secure than a traditional common stock. And then lastly, there's also partner equity. So companies may have debt, but they may also have partner equity instead of stock. And so there's various types of ownership interests in businesses, but we put it all under the equity section of the balance sheet, which we're going to look at in 1 second. You don't typically have common stock and partner equity. Typically, it just depends on the type of corporation that one is invested in. But we'll talk a little bit about that as we move forward. I think the last thing, that I would say about equity is if you sold all your assets and you paid all your debts, right? All your liabilities, what you have left is equity. And that is what would be left to distribute to whoever owned the company. And hopefully there will be a positive number. Otherwise, you got to go back and get more money to pay the remaining outstanding liabilities or the debts of the company, the bills. We talk about the balance sheet. And again, the balance sheet, I may be spending a lot of time on this because it is really the most important financial statement, in my opinion, specifically in the wine business, because it tells you where you're at a moment in time. Operating statements are highly accrued and can be organized in ways that are instructive on the business, but the balance sheet tells you where everyone's at. Where we do, I talked about current and long term. The order of liquidity is important. Cash is the most liquid. Then you got your receivables. Then you have your other assets. Then you have your inventory, fixed assets. Things like buildings are harder to sell than inventory, usually because they're bigger and more expensive. So we always organize our balance sheet in that order. Liquidity. So once you've gotten done with the order of liquidity on assets, then you move to the order of liquidity on your liabilities and then equity. And equity is also an order of liquidity. Preferred goes first. All right. Here is an illustration of a really, really healthy, growing wine business. And the reason I say it's wine business, and I'll just hopefully see is my mouse on the screen? Can someone give me a nod? Okay. So I'll talk very quickly through these categories. We've already gone through them, but the top half here you can see is broken. This sheet's broken in half, total assets. Everything above it are the assets. Again, in order of liquidity, cash is first. This company's got a growing cash balance. By the way, these are not real numbers. If wineries are generating this kind of cash, we should have a conversation because they're not putting their cash to work. That would be the argument I would say looking at this. And what I mean by that is having all your money in a bank account is not a great way to invest your money. You want to invest it in other assets, especially in a growing business like this. Accounts receivable are those amounts that people owe you for what you've sold. We have the inventory section. We talk about the growing crop. This is grapes. So the growing crop and I did some magic numbers in here. It costs us money to grow our grapes every year, but it's technically at the time while it's on the vine, it's inventory. We just haven't converted it into a finished good. It's early on in its life. The next section is bulk wine. For those of you in the wine business, those are wines that just aren't cased yet. They're sitting in barrels, they're sitting in tanks. They're going to be ultimately packaged and put into a bottle. And I've hidden a bunch of stuff in here because this was really long, but I just thought as I mix numbers up, it'd be kind of fun to show a wine business. Cased goods would be those finished goods. Again, these are all inventory. Those categories all subtotal down to the total inventory value that we have. Again, a current asset. And then we have other current assets. These would be things like deposits or other sort of things that we've made that will ultimately see money back upon, but that are short-term in nature. Current assets, total current assets is an important line here because this is the stuff that we believe, with the exception of inventory, that we'd see return upon within 90 days. We talk about fixed assets, and I mentioned some of the big ones: land, buildings, equipment, furniture, fixtures, vehicles, construction in progress. So construction in progress is something that is not technically finished as a large fixed asset, but it's something we're going to complete. So in the process of building a building, I'm spending all this money, but because I can't occupy it, it's CIP, construction in progress. And then we have this funny concept called depreciation. And this would warrant a 3-hour call, so I'm going to move right through it. Depreciation is basically the recognition of the costs of developing an asset over the life of the asset. Don't read too much into that. We have our net, so we remove that value that we've depreciated of all of our assets because they decline over time. We've consumed those assets by using them over time. It's an IRS and a tax basis for us for how we can get credit for all the money we've spent. And then we have other assets, and again, deposits. And then that intangibles concept I mentioned, things like your brand, your labels oftentimes are considered intangible because they may be really cool and have great design work, things that aren't necessarily things you can touch. A really important one maybe in the wine business is your website is an intangible asset. I mean, everyone can see it, but it's not like a physical hard asset. Then we talk about the current liabilities or the liability section. So kind of the key ones that we see there are things like accounts payable, what you bought from someone else that you haven't paid for yet, your accrued salaries and wages. So we all get paid every other week, unless we're getting paid every month at the same time period on the beginning and the end, or the beginning of the month. We accrue what we owe people for that time period between the last day they were paid and the end of the month, or in this example, at the end of the year. We still owed money for the 5 days of that pay period to people that hadn't been paid. That's an accrual. And we talked earlier about accrual accounting. And then other expenses. You might imagine we've got other liabilities that we haven't fully paid at the end of a period, and we need to make sure we record those in the year that we incurred them, really for tax purposes at the end of the day, because the more expense we have, we can reduce our income and have a lower tax liability. We have our deferred tax liability in this particular example. So those are taxes that were owed, but because of the structure and nature of the business, they've been able to defer them to a later date. They still owe them. They're going to have to pay some tax at some point in time whenever there's either the financial wherewithal or the company's gotten to a certain point where it will kick off and pay its tax liabilities. Those pieces are certainly other things that we consider that we owe at the end of the day, but we don't necessarily have to pay today. Then we get down to the last section, the equity, and I see it's kind of gone into the orange. Sorry about that. Common stock, paid in capital. So common stock typically has a par value or a value people pay to own stock. The difference between that and what they invested is the par or the paid in capital, the excess amount. Retained earnings is a concept of the historical profit and loss of the company as it rolls forward into the future. And then the last section here you can see is the current year income or loss. And although we had a loss in 2020, everyone remembers why, what we saw is that we had really big profits rolling for the balance of the year. And these numbers here, this last line, and I apologize if it's hard to see, these are going to be the same numbers. As I said, these are all, there's a through point on the balance sheet, the income statement, and the cash flow, and it's really running through net income. So you can see that here, and I'll just make a point of saying 3.198 is our income in 2026, and we'll look at that in a second. All right, the income statement. It's a period of time, and I mentioned this. It's a statement of time, period, a month, a week, a year, a decade. Typically, we look at these on a monthly, quarterly, annual basis. But you can look at income statements over any cycle, a week, a day, depending on your business. Income, hypothetically or in general, that's revenue. Revenue, income, we kind of use that interchangeably, not to be confused with net income or net profit. Those are your sales, right? What are you selling? What are people buying from you? What is your business doing that people are paying for? Operating costs, we'll talk a little bit about cost of goods. So what are you selling? What does it cost you to make it? Or what is that unit that you're making and how much does it cost? And then in this example, a wine bottle, right? All these years waiting for it to become a finished good, pay the packaging, it ultimately becomes on a per unit basis the cost of the good that you would sell. And then you got your admin and overhead. So admin, we typically think of three things. Well, technically two in this example, but sales. So what does it take you to actually sell this stuff, right? Who are the people? Where are the markets? Do you have to travel to do it? What are those costs associated with that to monetize your assets, whatever you're selling, in this case, wine. And then general and administrative. So G&A, which is an abbreviation for that, is people like your accountants, people that are counting those beans, making sure they get lined up in the financial statements that you're going to be looking at and making decisions upon. The other stuff that would fall in here would be like legal, your lawyers or your consultants like me, or the other costs that you might have to run your business, your rent, right? You wouldn't necessarily charge that back into the other things. You might pull pieces of that into costs, but most of those are your overhead costs that you're looking at. We have this whole section that we talk about, which is non-operating. And I mentioned depreciation in the accumulated section earlier. I won't go into the details. Like I said, that takes me years to figure it out. But things that are non-operating type expenses, because they don't affect the direct operations, right? I don't have to pay to travel. If I'm amortizing or depreciating my building every month for $5,000, it's going to happen anyway. It's not operational. It doesn't affect what I do day in, day out. It's going to occur. Interest expense is one of those things you might think of, or interest income for that matter. If you've got investments in securities or the bank, they give you money every month. It's not operational. You're not doing anything to direct it per se, other than maybe moving investments around. And then lastly, taxes. Taxes are really important. Again, you could have a master class on that. I'm not a CPA, so I'm not going to talk to anyone about their tax situation. And then at the end of the day, the net profit and loss of the business. Revenue minus cost minus non-operating expense equals profit. Here's a real simple example of that, and I'll hustle down to 2026. We're selling $7.8 million in our inventory, wine. We charge tasting fees. And if you looked over time, you could see that they've gone up, they've gone down. That's an important thing to think about, and we'll talk about metrics in a minute. We have our totals. COGS is a short term for cost of goods sold. What am I selling? What's the cost of doing that? Whether it's a widget, a piece of software, whether I'm selling consulting services, what's my cost of doing that? Or a bottle of wine. It takes a long time to make a bottle of wine. And then do I have a cost of what I'm pouring or giving away to get people to buy my wine, right? And that's an example we see in a lot of wineries. This winery's got a really healthy gross profit, which is your revenue minus your cost of sales, your cost of goods sold. This looks like a largely DTC winery. It's someplace that would be probably really fun to work because it looks like they're going to generate a lot of cash. Operating expense, so sales, general, administrative. I've combined kind of all those in this category. Sometimes people break those out in two different sections, right? You can have really long, detailed income statements. I've consolidated for purposes of getting it onto one page. I don't want to bore you any further. I've rolled all those costs in here. And what we've really looked at is if you want to slice it a different way, you could look at sales and operations or admin a different, side by side to see what the combination of all these numbers might be. But think about the costs that we incur every day, dues and subscriptions, the licenses and permits we have to run our business and sell wine to other cities or to other states, if you will. Salaries, wages, commissions, all these things that take us to run the business for a period of time fall into the income statement. They got to pay you to come to work. This is where they put it. Benefits. We all have them. We wish we have them. Supplies, property tax, which is typically, property tax gets bucketed in lots of different places. I left it in here just to keep it because I didn't want to have too many lines. Insurance is associated with what we have to pay, right? We got to insure our business to make sure that we don't hurt someone, or if we do, we've got coverage for that. Utilities. I don't know how many people work without utilities. Outside services, I left in payroll because oftentimes small businesses, they don't do it themselves. I mean, they can, but sometimes it's cheaper to outsource that kind of work to others. You have your accounting fees. Look, these accountants pretty cheap for on an annual basis. That's a good price. Legal fees, that's really cheap, and that's probably not realistic because it's legal fees. Admin and other. So a lot of times people just categorize things as other buckets. So when things don't have nice matches or it's not something that you want to put into a simple category, you accumulate it into a larger category. Make sure you can understand it. Make sure you know what's in it. We'll talk a little bit about that at the very end. I think it's my last phrase. The information that's in here is effectively codified, right? I didn't list the account numbers in here, but all these names would have in accounting their specific language or word is oftentimes a number. And that can be confusing for people. It's like, well, why are you putting a number in to record a number? It's just the way, again, we organize our business through a chart of accounts, assets, liabilities, equity, and now we're moving into revenue and then costs. And then as we keep going down, we get to the end of our chart of accounts into the other income and expense or the other costs. Most organizations are structured the same way. That's why when you know accounting, it is a language. You can almost go to any organization in any type of business and it'll roughly be structured the same way. And the systems all basically function the same way, some differently than others because of the nuances of industry, and some differently because the way they organize and capture information is different. But they all sort of ultimately perform the same work. And we talk very briefly about that at the end. And then down below, and I'll get to some of these acronyms shortly, depreciation amortization falls below EBITDA. EBITDA isn't a foreign term. It's not a new word. It's an acronym. Earnings before interest, tax, depreciation, and amortization. And the reason why that's kind of an important one to remember, it's always earnings, hopefully not losses. Earnings before, so EB is really straightforward. And then you can carry down what it is that you're putting before there. The reason we take out depreciation and amortization in this example is because those are non-cash. And why I say that is because depreciation is the recognition of what I spent a long time ago. I'm now just recognizing it for tax purposes. Again, could have a whole conversation on it, but it's not something that really is worth going through today. But I wanted to point out here, as I mentioned on the prior schedule with balance sheet, is that this number ends with the number that was at the very bottom of the balance sheet, 3.198 million. Hopefully you all remember that. All right, I'm going to keep hustling here because now I see I'm almost out of time. Cash flows. We represent the cash usage and availability of the business, and we document it. Okay. The reason we do that is because it ties to the balance sheet and the income statement. It brings it together. And cash is king. We have three sections. Cash from operations. What were the operations? We sold something, we had to collect it. AR, AP, inventory, other assets and liabilities. You saw those payroll, wages, accruals. Those are operational. Then we have investments. So the next section is investments. We buy buildings, or we make investments in buildings. We buy land. We plant vineyards. We buy other assets. Barrels is a good one for the wine business. All those other longer term assets are in that category, in that section. Then we have our financing. So how do we pay for all this stuff? If we're not generating enough free cash ourselves, we got to find money. So who do we go to? We go to the bank. We borrow money from friends. We sell stock. We find other ways to generate enough capital to do and run the business that we have. And you'll see this in 1 second. When we go to the cash flow statement, I'll point to the first line. The cash flow statement reconciles the balance sheet and the income statement. It starts with $3.198 million. That was your profit. But then you had all these other things that happened. So what were they? Well, we want to reconcile net income to net cash. That's accrual accounting. So what I've done first is I've removed my depreciation and my amortization. Again, long course on this, they're not cash. They really weren't. You recognized them, but you got to add them back because they weren't cash. You spent the money a long time ago. You had a change in AR. In this case, your accounts receivable, and you see it's got a bracket around it, it's a negative number. Anytime a negative number appears on a cash flow statement, it's a use, meaning it's cash going out, or whatever out is in this world. It's not coming in. Versus inventory, we sold a lot of inventory. And by doing that, it generated in this year $1.7 million of cash. It was in there in that inventory section on the balance sheet. I sold it and it became cash to me in the business. That's offset by some of these other things that I had to generate, spend money on new prepaids, other assets that I had to acquire. They took money. So what we're doing here is we're depicting how the business flowed, inflow and outflow of the cash in these sections. The operating cash, $4.18 million, healthy business. We didn't have a lot of investing activities because I didn't buy any barrels. So that's why it was such a good year, because I didn't spend a bunch of money on other stuff. If I did, I had $4.1 million to spend it on, right? I could have spent all that and still not needed someone else to give me money. And at the end of the day, we didn't borrow any money from anybody else. Again, trying to simplify where we ended up. I'll just point out that this $19 million at the very bottom, remember how I said earlier, it's a lot of cash on the balance sheet. You didn't use your assets very well. It's exactly here we didn't use our assets. We could have bought stuff. We could have invested in our business. Again, net from investing. We didn't make any. We kept all the money in cash. Maybe we're trying to liquidate. I don't know. It was a hypothetical. All right. Interpreting. So there's lots of ways to interpret financial statements. Oh, look at that. It's not very clear. Unitization and trending of your financial statements and your data is important to analyze it and to interpret it. You can't look at a number and say, oh, that means something to me. You got to look at a number compared to something else or as a unit of something else. And in the wine business, we think about dollars per case, dollars per customer, average order value, all these different metrics. Those are really, really important. But even those metrics aren't really meaningful unless you look at them in trend or over time or at points in time and compare them to one another. And that's really big on Wall Street. You hear people talk about the metrics, the price to earnings ratio. We talk about graphical representation. Sometimes pictures are easier than numbers. And for most people that don't work in accounting and finance, they start with the picture because it tells the top level, what does this really mean? A pie chart, a line chart. What is it that I'm talking about? Key formulas. Key formulas depend on every industry, but the big one that we think about in the business from the income statement side is the profit margin. Margins are usually described or explained in percentage of revenue. So when people say my margin is, they're talking about in the percentage of revenue for that number. Gross profit, net income. What is a good margin? So on a net margin, if you're in the restaurant business, 3 to 9% is pretty good. If you're in the grocery business, 2% is pretty good. If you're in the software business, 25% is pretty good. And that comes back to every industry. It's specific. It depends. In the wine business, healthy margins are somewhere in the 20% range. If they're much higher than that, I don't know what they're doing. They're 100% DTC or something. But it's hard to run that kind of a margin in a wine business just because the cost, the capital intensity is so high. When we think about other key formulas or metrics that we look at, especially in this environment where cash is very challenging, but wine industry is very challenging, your day sales outstanding, which is a depiction of how much money when you sell or how many days when you sell something does it take you to collect it? It's a big, big question right now on getting paid from customers. Also on customers paying. Talk about liquidity measures, net working capital. How much money do I need to operate the business every day? Those are key things that people want to understand. Your current versus your current liabilities less your current assets less your current liabilities. How much money do you need to operate for 90 days? Those are really important to understand, especially when collections, your days sales outstanding are growing. If it takes you longer than 30 days to get paid. And then debt to equity, again, how much money do you have versus how much did you borrow? One of the ones you'll hear about in Wall Street is price earnings. And that is a real simple number at the end of the day, but it gets a lot of interest, right? PE ratios. And that's the stock price metric. Basically, profit divided by the number or the price per share. What is the price for the earnings of the stock? It's the one a lot of people use whenever they're talking about investing. What's the PE ratio? So what are some red flags? Leverage. What I mean by leverage is debt. If a company is overly indebted to the bank or investors, it's tied that money up based on some collateral. A lot of debt can become very, very challenging for a business, especially in this environment where you don't have churn or sales or inventory turn. It becomes really challenging. A couple of ways we measure that and look at that is a concept called times interest earned. So when we look at EBIT or EBITDA, how much money or is EBITDA versus the interest that they're going to pay, which falls below that? Is it 5 times? Is it 10 times? Healthy businesses can't have high leverage and interest expense without putting themselves in real risk of not being able to make their interest payments. If you don't make your interest payments, the banks have issue because you have too much debt. Same thing with debt service coverage. It's the same concept. Profit margin and gross profit, all driven by percentage of revenue. All your metrics as a percentage of revenue are meaningful because it tells you how you're performing against what money you generate. How much of your revenue is it consuming? I like to think of things in better or worse. Look at trends, look at the data, unitize where you can, per case, per customer, per employee. Trend that information on your financial statements. It's all available. Use it that way and look at it not just statically at one number, which is maybe meaningful. How much did we sell a case for? Yeah, but how much did we sell a case for over the last 12 months or 10 years? How much did it cost us to make a case over the last 12 months or 10 years? What's that change? The percentage, the ratio of the change. That's what people you would want to look at. And if they're declining or they're going the wrong direction, those are issues. Those are red flags. Watch all the things on a historic and a periodic basis. Are they improving or declining? Look at inventory, especially in the wine business. Inventory is cash, right? You spent money to make inventory, especially in the wine business. It sits on that balance sheet for too long. Not only do white wines tend to have challenges going over long periods of time, but the bigger your inventory grows, you can think about that as basically consuming your cash. Velocity. That's the speed at which your inventory turns. So when you make a product, if you make it and you sell it every 90 days, your velocity is 4 times a year. Wine, we don't necessarily have the same velocity, but that's the concept. How quickly do you turn your inventory over? Because that's what's paying your bills. Think about your backlog. The bigger that inventory gets, that is cash. It is all sitting on your balance sheet as cash that you have unrealized. This is just a quick revenue representation from the schedule I had. 3 lines. Here's the wine sales, here's the tasting fees, and here's the total. You can use graphs to tell you any story that you want. Use them. Because sometimes it's easier for people to interpret, especially executives or people that aren't finance people. You can build graphs. Most of the analytical tools that are out there build them for you. So use it. Financial applications. Technology is changing. It will continue to change. AI is becoming mainstream. Don't be surprised if it takes and does a lot of this work for us in the future. Use it, understand it, enable it. It'll make your life easier, especially with routine tasks. There's off-the-shelf type financial systems. You've all heard of QuickBooks, I'm assuming. Quicken is another one. Microsoft Money. There's bank apps that do a lot of this accounting financial statement organization for people. There's proprietary systems. Large companies build their own. Small companies buy them off the shelf. Subledger systems. When you go to buy lunch or something, they'll use a subledger system. They'll use Toast or they'll use a POS system like C7. That information ultimately gets fed into the general ledger, the accounting system, and then creates the financial statements. Enterprise systems. These are systems that collect everything. Customer data, winery data, historical data, and they use it as an enterprise tool. Vendor analysis, et cetera, et cetera. Lots of things they use those data systems for. They're larger for big organizations with integrated operations. Financial statements are useful. They really can be beneficial. I mean, it went a lot faster than I thought it would. I tend to talk a lot. But they tell you about the health of the business. And every statement's, every company is different and what their health is can be evaluated by looking at those financial statements. They provide decision support information, right? As I said all along, it's really just the accumulation of that information. It's helping you make decisions about your business, good and bad decisions. But I will tell you that it relies highly upon the quality of what's put in there. And if you don't put good information in, you will not make good decisions coming out of it. If you have good information, you can make a bad decision. But if you have bad information, you will certainly make a bad decision because you have the wrong information to make the decision upon. I got another slide here. Oh, Q&A. Wow, I gave you 5 minutes.
That was good. We appreciate
it. Fast enough?
Yeah, that was awesome.
Okay.
We'll open it up to any questions. If there are, I have one which I can kick off with. I'm just curious, when we think about particularly small businesses or solo entrepreneurs, are there resources that you recommend for a one-stop shop, for lack of better terms, who maybe doesn't have the funds in order to hire accounting
Yeah.
or a CFO?
Yeah, I mean, a CFO is a stretch. I mean, most
Yeah.
wineries are small enough; they don't need a full-time CFO. It's just they're too, that kind of work is too expensive. So my first comment to that is, almost all the accounting software systems and tools are online. QuickBooks online, and I don't get anything for this other than to tell people I see a lot of small businesses, and I myself use that kind of a tool. It's literally becoming sort of self-directed ways to create your business through these tools that are available online. QuickBooks is really simple because it's ubiquitous. Many people know what it is, but it's also something that you can do no matter where you are on the planet, whether you're in Napa County or Mumbai. You can be using QuickBooks for the same data set with someone who's somewhere else. And so those online tools exist. There are others. It's the one I'm most familiar with. And so if I wanted to keep my answer short, I would say use that tool, but don't be afraid to ask your AI agent, what would you suggest? In Napa County, there's a lot of firms that do bookkeeping and support that kind of stuff. Taking a phone call costs nothing, right? Pick up the phone and call, send an email. My contact information, I'm sure, is available through the chamber. I'm happy to give, advice, free advice on where you might start if I know enough about what you're trying to accomplish. If you're trying to build a multi-billion-dollar business, don't start with QuickBooks. Does that help?
Great advice. Yes, absolutely.
That's the short answer. I mean, you can do things in a spreadsheet, really simple stuff in a spreadsheet.
Yeah.
So it doesn't have to be exotic. As long as you can track your income and your expenses, you can produce financial statements from really any tool today. And like I said, the technology and how it's enabling what we're doing, a lot of the stuff, you just feed it a little bit of data, it'll do it for you. And I'm not kidding.
It's great. It makes it easier for our business owners, that's for sure.
Yeah. I'm going to give one example because I learned this the other day. If you go into your bank account and you take your last 10, 12 statements, let's do 12 because that's a year. Take your last 12 statements, put it into an artificial intelligence agent. Doesn't matter who you use, whether it's Anthropic through Claude or ChatGPT. Take those 12 PDFs, put them in, and say, create the financial statements for me. It will do it for you. It is quite remarkable. I'm going to be out of a job soon.
Wild what technology can do.
It's crazy. It's personal stuff too.
Yeah.
Okay,
we have
David.
one question in the chat. Yes, from David. For brand names and other intangible assets, how is the value determined? Great question.
It's a great, yeah. So I think the first answer to that is the intangible asset. When you pay your designer or you pay for someone to help you create your logo or whatever it is you're putting in our books, that is what is on your financial statements. That's the value or the book value, right? What's on your books? It's the book value of that asset. What it's worth or the true fair market value depends on what someone's willing to pay for it. And I know that sounds a little curt, but that's the reality. A lot of us have these intangible values or intangible assets on our books because we've invested over time to build new, marketing things or logos, or we've invested in consulting to help us create a portfolio of what we look like and how our brand looks and how it engages with the marketplace. But that's the true book value of that. And a lot of those expenses, or if you will, assets are amortizable over a period of time. What it's worth or the value of that is what someone will pay for it. What on in your accounting statements or your financial statements or on your balance sheet specifically is what you've invested in it. So is it worth more than what you invested in it? Depends on who's buying it. And I have a really good example of this in my world where, people have a lot of money invested in brand, but nowadays, because customers don't see the same relationship with the brands that they have in the past, and maybe that's the new cohort, or maybe just our ability to get them engaged with what we're doing or building our stories around that. They don't see the tangible value of why it would be worth more than what the intangible value on the books is, or the net intangible value on the books. So I know that's probably not the answer you want. It's very difficult to value a brand. Like I said, at the end of the day, you could look at your earnings over the number of years, and that's typically the way people value businesses is they look at the future cash flow stream and they discount it back to the current day if you will. So look at the projected future cash flow of the business and then discount that back based on cost of capital, what it would take you to buy it and borrow the money to buy it, or whatever your cost of capital is. That would be a theoretical way to calculate it. But the way I've always, kind of help people establish what their brand is worth is start with the tangible assets, look at the free cash flow, and determine what the market believes the multiple of those cash flow streams would look like in your business. And that's gotten real tricky in the wine business these days. And I won't go into the details of what it was versus what it is today, because I think it's anybody's guess. What do they say? You're only worth what someone's willing to pay.
Yep.
It's a great question, though. If I had a silver bullet for that one, David M., I'll tell you, I'd be richer than rich.
Are there any other questions before we give everyone their morning back?
Oh my gosh, this was so much fun.
I'm so glad. Well, we loved having you. Thank you, Richard.
Yeah, we'll see. Thank you all for your time, and hopefully I went through as much that was enough for people to understand and interpret. But feel free to email me. I know the chamber's got my contact information. I am a chamber member and former board member, so always happy to be a support and give people areas of information that I might be helpful with. And I appreciate everyone's time today.
Amazing. Thank you so much. And thank you all for tuning in. We really appreciate it.
Yes, thank you, Richard. It's awesome.
Yeah.
Thanks, David. Be well.
Awesome. Thank you all.
Okay.
Enjoy
Thank
the rest
you.
of your week.
Yeah, have a great week. Bye-bye.
Take care.